Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Mark Erickson. Mark is a family law attorney whose firm is located in Campbell, California. He graduated with a JD or law degree from Santa Clara University of Law in 1979. He was admitted to the California State Bar and U.S. District Court, Northern District of California in 1979. And after working for another attorney, mostly in the areas of civil and business litigation from 1979 through 1984, he founded his own law firm in 1985. He became a certified family law specialist by the Board of Legal Specialization of the State Bar of California in 1987. He's lectured and presented seminars for many groups, including as a teaching assistant and guest lecturer at the Santa Clara University School of Law. And in his other life, Mark plays amateur ice hockey. He has two adult sons, and one of his sons is following Mark's footsteps as a lawyer. So Mark, thank you for joining me today.
Thank you.
Okay. Today, Mark and I are going to be talking about dealing with a family business related to a divorce in California. This is a complex area of law for which you should consult your own attorney, and divorce laws vary among the states. So we'll give you some ideas, but you definitely need to get the details from your local attorney. Also, I'll mention there are other interviews with Mark I've got on financialinsiderweekly.com on different topics, so take a look there under past episodes. Okay, Mark, let's get on with this because we're going to be really lucky if we get through much of the material that we talked about.
Okay.
Why is the family business a difficult item to deal with in a divorce?
Well, I guess you can almost have emotion on top of emotion.
Yes.
Because a breakup of any business, whether a partnership or a small corporation, it could be filled with emotion even if folks aren't married. So you have that overlay of divorce, and it can be particularly difficult. Sometimes both the parties have been instrumental in building that business. They may each feel, even the spouse that wasn't working in the business may feel the same level of sweat and sacrifice over the years that went into building a business. Mm-hmm. So it can be a very emotional thing, and it can be one of the more complicated assets that we deal with and divide in a dissolution of marriage.
Mm-hmm. Okay. Why is it hard to put together a spousal support or a child support agreement when you have a family business?
Well, first, child and spousal support decisions are made in large part based on the parties' incomes. And right. So if there is a family business and one spouse is operating the business and receiving the income from that business, that income is going to go into the formula to determine child and spousal support. As well as the other spouse's income if they have other income. But when it comes to a business, it's not always easy to determine at any given time what is the income. Mm-hmm. You may have old tax returns that tell you at least what the reported income was in prior years, but the reported income isn't necessarily the same as income available for determining current child and spousal support for a number of reasons. Mm-hmm. One, it may not be reliable because the information only is as good as what's put into it. Yes. And not all business owners are completely accurate and truthful in their financial records.
I didn't hear that.
So that's sometimes a dispute, is the accuracy of the records. Mm-hmm. There are things on tax returns that would be perfectly fine for determining income taxes, but would not be considered in setting child support. For example, depreciation. Mm-hmm. In a rental property or business. Depreciation is not considered an appropriate expense against gross income for determining child support. Mm-hmm. So there can be a lot of considerations looking into the income of the business. The other thing is the spouse that isn't operating the business, they don't know from day to day or week to week. So even if they had accurate and complete information about their spouse's income from a business, say 6 months ago, they don't necessarily know what the business is doing now. If their spouse is telling them business is bad or I've lost a key employee, or my customers aren't paying. The spouse that's not in that business day to day working there really doesn't know how accurate that information is. And of course, the operating spouse has an incentive for their income to be as low as possible.
Right. So, well, one, of course, people, they want their income in many cases to look as low as possible for their income tax returns because they don't want to pay taxes on it. But there is the thing, too, that a lot of times when a business, particularly when it's growing, it's basically sucking up cash, and the money isn't available necessarily for paying for things. And I guess the third thing is many businesses are seasonal, like the CPA business, for example, for a tax practice. So they may have, a lot of cash flow that's happening, let's say in April and in May, but things are pretty lean maybe in November and December. So, so when you talk about having to make a monthly spousal allowance payment or child support payment, it's pretty hard to plan around that. And also some years are just better than others.
Well, that's right. And a business owner may make decisions that are good for the long term for the business and the business owner that might negatively affect short-term income to the detriment of the recipient of child and spousal support.
Okay. Well, what are some title concerns related to a family business?
Well, any business, of course, could be a sole proprietorship, like a professional practice, a doctor, a lawyer that has their own practice. They're small corporations and partnerships, so just about any type of ownership. But when we're talking about, I guess, titling between spouses is a business, even though someone may be a sole proprietor, so it's Michael Gray's CPA practice, it still could be community property.
Right.
Stock in small corporations, I'm surprised to see how often all of the company stock is in the name of one spouse and not the other, even though the other spouse might have done the work for the incorporation. They put all the stock in their spouse's name. It still doesn't mean that business isn't necessarily community property, but there certainly are often disputes about the characterization of the business. Is it separate, is it community, or is it some of each? Not unusual to see a divorce where one spouse started their business shortly before marriage, and then they're married for many years, the divorce comes, the operating spouse says the business is their separate property because they started it before they were married. And the other spouse would say, well, wait a minute, we've been married 20 years and all the value in that business built up during the marriage. We have a body of law that addresses that. In fact, it's as far as I know, it's been on just about every bar exam in California every year, the law of Van Camp and Pereira that tells us how to address the issue of increase in value in a business at the time of divorce where the values increase from the date of marriage to the date of separation.
Okay. What are some considerations when both spouses are involved in a business?
And it's very common, of course, that both spouses do work in the business, or at least have, at times, may have worked in the business. I've seen businesses where maybe the spouses started it together. Maybe the wife takes some time off for children when children are born, and then they come back into the business, or maybe they're doing bookkeeping work from home. But there can be a dispute at the time of separation of who should run the business, or can the parties continue to, in their roles as employees, working in a business together. And sometimes both spouses are really important to the business, but they can't get along, and they both want the business.
No, what are we going to do?
So the court may have to make the call. Who is going to run the business in the short term? And in the long term, there are often disputes on which spouse is going to be awarded the business, where they each want to keep it. Or there's actually some appellate case law on dealing with awarding the business to a spouse who doesn't really want the business.
That's interesting.
And of course, in a professional practice, you can't award a business to someone who doesn't have a license to run it. So if one spouse is a lawyer and the other is not licensed to practice law, you obviously can only award the law practice to the licensed attorney.
Right. What about even when they're in this process of divorce, you know, who's going to be operating the business during this time?
Yeah.
And I imagine a lot of these businesses sort of collapse, I mean, under these circumstances.
I think that's very common, and I mean, normally the spouse who is operating it during the marriage is going to be the one who operates the business post-separation until there's an agreement to sell it or award it to one spouse or the other. But you can imagine if that spouse is not doing a good job, or the non-business operating spouse thinks that their husband or wife is doing a poor job, or they're deliberately decreasing income to try and lower the value, or the spouse that's working really hard feels undercompensated if they're putting in an extraordinary effort. The law tries to address that issue in part by determining the valuation date of a business when you're going to determine the community property value for division purposes. And most assets in divorce, the law tells us, are to be divided at a value as close as possible to the time of trial or actual division or the time of settlement. In the area of a small business, the law tells us that on a request to the court by motion for good cause shown, the court has authority to make an order for an alternate valuation date, selecting a date as close as possible to the date of separation. Some divorces take years, and in the case of divorces with businesses, there's probably a greater risk they'll take longer rather than a shorter time. And so if the operating spouse does an extraordinary job and works very hard and builds the business up, it's probably only fair that that post-separation increase in value goes to them. On the other side, if they aren't making a good effort and the business value goes down post-separation because of their lack of effort, then it's only fair that they lose out for not fulfilling their duties to the community and operating the business properly.
Okay. Well, how about the area of professional practices like doctors, dentists, lawyers, CPAs? What special problems are there related to those types of situations?
Certainly in the area, I represent a lot of doctors and lawyers in divorces, and there's some
very many divorce lawyers.
Those are some of the most difficult cases. I guess lawyers can be difficult because even if they don't practice family law, they tend to think they know more than they do, and want to be involved in making decisions that perhaps they'd be better leaving it to their attorney. Doctors and lawyers are very difficult. If you look at the case law in business valuation cases, a high proportion of the appellate court cases were doctors and lawyers getting divorces. And a part of the reason for that is the peculiarities of the law and what we call the double dip, or some people talk about triple dips.
Okay.
And that is that the business owner can end up paying their spouse multiple times for the same dollars. And so the law tells us that to value a professional practice, one of the things we look at is goodwill, or the intangible value of the business, which is loosely defined as the expectation of future income, but that determination is made based on past income. So the forensics CPA may look at 3 or 5 years income and use some formulas, and if they determine there are excess earnings, meaning this professional is making more than the average doctor or lawyer in the same type of work, they have excess earnings. Those earnings can be capitalized, or a multiplier attached to them that leads to a value. So the lawyer says, gee, I'm paying my spouse for this money I made in the past that they think I'm going to make in the future. So essentially I'm paying with my future income based on what I made in the past. Another part of evaluation of a professional practice is the tangible assets, which can include accounts receivable. And a lot of Certainly doctors and lawyers are carrying accounts receivable for work they did before they separated from their spouse that hasn't been collected, and it's community property. And so as it's collected, theoretically, the non-working spouse should get half of those accounts receivable. So now that same money, again earned in the future, not only is paying perhaps for goodwill, but for goodwill. And then the third dip is that same income is now used to determine temporary or permanent child and spousal support. So I would say it really wouldn't be a stretch to see, say, a doctor, a lawyer, or a CPA getting a divorce paying out virtually all of their income, either to state and federal income taxes and their former spouse, in the form of goodwill, accounts receivable, child and spousal support, and it causes some real bitterness for the professional in that position. There is some talk of pending legislation in Sacramento to address the so-called double dip and force the court to at least consider that in looking at the issues of goodwill and spousal support and the interplay between the two of those to maybe bring a little more fairness, because a professional can really take a beating, especially early on in a divorce.
Yeah. It makes me think there was a movie a long time ago called Fitz Willie. It had Dick Van Dyke, if you haven't seen it. So his wife, or former wife, whatever, she ended up driving a Cadillac and he ended up driving a little Volkswagen. Because he couldn't afford. She lived in the home. He lived in some little hovel. So anyway, it sounds very challenging. So folks, again, part of our thought here is maybe we'll make you think again about whether you really want to go ahead with this. All right. Well, are forensic accountants really necessary when you're dealing with a family business?
I think they are. I mean, there are certainly cases where other valuation professionals might be used, but I would say almost every case I'm involved in that involves a business and divorce, we hire an accountant. Sometimes each side has their own accountant. Sometimes people will agree to use a neutral court-appointed accountant, and usually they're looking at value of the business and income from the business for setting support. They also are often hired to determine marital standard of living, which is a consideration in determining long-term or permanent spousal support. They also may look at characterization issues if there's a question about a business, whether it's entirely community property or separate property or some mixture.
Mm-hmm. And so one of the things that we were talking about related to this is, when we get these specialists involved, of course we've got, the basic divorce attorneys who are expensive enough, but then we pull in these forensic accountants, and now we've got one for each of the spouses, and whatever other specialists that we may need along this. This divorce is pretty darn expensive, and so can there be some cost-benefit thinking that goes on related to this? If you've got particularly a small business there's really not a whole lot going on. Maybe it's $25,000 a year or something. And you could pay $100,000 for administering this thing.
Well, there has to be some consideration of the cost and the value of that. On the other hand, if, as an attorney, if I'm representing someone whose spouse is operating a business, mm-hmm. I have an obligation to make sure that my client is reasonably informed so they're able to make an intelligent decision about settlement, or if there isn't a settlement, we have to be prepared to go to court and present the case with appropriate evidence. And so the costs that you have when there's a family business may be just as great if the business has limited value and a low income as it might be if it's a very successful business that's worth a lot of money and there's a tremendous income. In fact, some of the highest income, highest asset cases I've dealt with have been some of the easiest and relatively inexpensive. So one thing I see is the litigation a lot of times is driven more by the emotion of the parties than the true issues presented. And sometimes the people who have the least to fight about are the most willing to fight with each other and spend money they don't have, or they may be funded by relatives or friends that are fueling litigation, some of which often is unnecessary. But sometimes these expenses are just a necessary part of the process. It's like when you buy a new car, it's a shame you've got to pay the document preparation fee and the sales taxes and all that goes along with it, but that's part of the process. And getting divorced, part of the process, particularly if you have a business, is probably going to involve some extra work by appropriate experts to determine value and income.
Okay. Well, we've been talking sort of around this issue of valuation, but let's sort of hit it a little bit head on. And so what are some things to think about related to valuation for a business in a divorce?
Well, I guess it depends on who you're representing, but let's say I'm a neutral. If I were a neutral, say a mediator or a judge, trying to determine value, you have an obligation to consider all the aspects of valuation. You're going to look at the tangible and the intangible assets. Tangible assets are often easier in a case of a business that keeps good books and records, and these days I say 90% of the businesses we deal with use QuickBooks, which is reliable, at least reliable to the extent that the information put into it is reliable. So you're going to look at cash, you're going to look at hard assets. You may rely on book value, but some businesses you won't. You'll need to have appraisals of tangible assets, for example, machine shops. Machine shops often have, and we have a lot of them here in Santa Clara County. I think we maybe used to have a lot more.
Yeah, we used to have more, yeah.
Yeah, there was a period of time for years where I always had at least one, if not several, machine shop divorces ongoing. But a company like that will have very expensive machinery. It may be fully depreciated, yet it still may be very valuable. You know, some of these machines cost hundreds of thousands of dollars. So you may have to hire a special appraiser with expertise to determine the actual value of those tangible assets. A lot of businesses, like a law practice, you know, what do they have? Some desks and computers, and there isn't going to be a lot of tangible asset value other than maybe the cash in the bank and the accounts receivable. The intangibles is where we often see the big disputes, and that's often a battle of the accountants. I know you're an accountant, and I'll tell you, if we had 10 different accountants valuing the same, say, medical practice, say a successful, high-earning surgeon, I would bet you those 10 CPAs would come up with 10 different values, because they're going to make different assessments of risk. They may make different assessments of what are comparable earnings, meaning what does another surgeon in that type of practice in the community make on average, and is this surgeon making more than that so that they have excess earnings? And then if they have excess earnings, how are they going to capitalize those earnings? And different accountants will do that different ways. They also may make judgment calls about whether some of the claimed business expenses should be treated as business expenses. Certainly some small businesses will have the family car as an expense, and even though the surgeon only really uses it to drive to and from his practice to the hospital a couple times a week, he may be claiming it's 60 or 80% business use, and so you may make an adjustment for that.
It's not one of my clients.
No, certainly none of yours, but sports tickets, you know, what do you do with the 49ers or Sharks season tickets? Are they 100% business, or are they something else? So the accountants will make adjustments on things like that, office Christmas parties. Some of those things are sometimes relatively minor, but sometimes there's some big items, and major judgment calls are made by the CPAs that can make a big difference. one of the things we find in this community that I hear from other lawyers is there's only a handful of forensic accountants that seem to get all the work, and I think there's maybe a concern on the part of attorneys that they're nervous to try out a new accountant that haven't demonstrated that they know how to put their case together and testify well in court. But there can be a lot of issues in business valuation, and people would be surprised to see how some of these disputes play out and how expensive they can be.
Right. Now, how do judges take these appraisals? I mean, do they just, okay, we'll just take that one, or?
Well, a judge's job is to make a decision based on the evidence presented. So if there are competing accountants, if the court has appointed its own expert accountant, we always say the court's own expert tends to carry a lot of weight, and so you may have a more difficult job convincing the court to have an opinion other than its own expert. The law tells us a judge cannot just take one accountant's number and the other accountant's number and say, I'm going to split it in two and just average them. They can't do that. They might come up with a number that's close to the average, but they have to have a rationale. They can't just say, I'm going to cut split the two appraisals in the middle. I guess the court determination is going to be based on the credibility of the experts as well as the other witnesses. Some of the business value may be determined based on the owner-operator and issues of goodwill. There may be some assessment. Is this guy a 65-year-old surgeon that doesn't have many more years to practice and doesn't have much goodwill?
Yeah. Mark, thanks so much for joining me. We're all out of time. Folks, hope that we've given you something to think about, and think very seriously about this area when you have a family business, whether to go ahead or not. And certainly that you need to get good legal counsel in the process as soon as possible. Giving some good things to think about here. See you next time on Financial Insider Weekly.